Welcome to the Ty and Rye the Finance Guys podcast, covering weekly investment news, important financial topics, and expert interviews. We want to help you become more knowledgeable about the financial world around you. This is not an offer to sell you anything, and remember, past performance doesn't indicate future results. Now your hosts, Ty Hansen and Ryan Robertson.
Hello, and welcome to a new episode podcast. Ty and Rye the Finance Guys. Hello, Tyler.
Yep. Ty and Rye.
Yep. Hello, Tyler. Yep. How's it going today?
Yep.
You feeling good?
Yep.
It's a good response.
I am good. I just ate my Snickers bar and I've got a Coke. So all that sugar about mid-podcast should hit my bloodstream.
Yep.
And so, like,
I have a feeling. What?
When the audio starts to spike, like kind of mid podcast, that's why. So
I feel like we're going to need to have a diabetes expert come in for a podcast and instruct us on some issues about sugar intake.
I agree. I agree. Hey,
agree.
You know what? That is true. I agree. You know what's interesting? That's funny you said we should bring somebody on. I actually, so I've talked about this a few times before, but you know how I've got the one of the guys that I like to read is that Timmerman dude from Fidelity, right?
Yeah.
I actually, because he's interacted a few times with me on Twitter. Wow. And so I actually reached out to him and I said, "Hey, one of these days you should be on our podcast."
Yeah.
So we may get one of the chief economist writers for Fidelity on our podcast.
That'd be great. Rad. That would be really great.
We don't need diabetes people. We want Fidelity people.
Yeah, I mean, we just may need to if you have some health issues in which you're gonna, need to go on some insulin.
Yeah.
So
insulin. Well, that's the only reason. That's why I run, like a freaking maniac, is so that I could eat this crap. So.
Yeah. Well, hopefully that guy can come on and help us with our topic today, because we're continuing our series, Peak to Trough. This is episode number 4, and it's going to be sort of a hybrid episode. We're going to talk about cryptocurrencies because that is our current speculative investment. We talked about the dot-com bubble. We talked about gold. We talked about the 2008 financial crisis. Now we're moving on to cryptocurrencies. We've already talked about it a couple of weeks ago. You can go back and listen to that. This is going to be a little bit more of a brief kind of overview of particularly Bitcoin, because that's kind of the biggest, most important player right now. Right. But it'll give you a sense of it. And then the last part, we're going to focus on some of the key components for picking out when there is a speculative investment, what to do, how to know, and how to go about it.
Right.
Either avoid it or potentially, if you are going to invest into it, how to invest into it.
Yeah, and the whole point of this peak to trough thing is kind of, understanding historical similarities, right, between these things that pop up.
Yeah, they're very similar. It's funny because they're similar.
Yeah, and not to get ahead of ourselves here, but every time I've been doing this long enough now that I see similarities in the way that people respond to these kinds of things, right? And what they want, right? It's like, anyway, so we'll get to that in a minute. But
the funny thing is that so much of it is human psychology. So much of it.
Yeah,
that's what drives it.
Absolutely. I mean,
we'll talk about that.
We did not do an episode on cannabis, right? But we did kind of kick around that idea about maybe doing one on cannabis because, I mean, when was the last time that you really heard anybody say, "Oh yeah, I really want to get in on cannabis"?
Yeah.
I mean, maybe if they want to smoke pot, but not for the investing standpoint.
A couple years ago, you could hear 2-3 years ago, you heard a lot about it.
Yeah, exactly. So
the banner ads stopped.
No, this is banner ads. The banner ad. Yep, that's it. That's right.
Yeah. So we're going to just dive into a couple of ideas with the crypto speculative bubbles, and the craziest part of this to me is it's not just one. We've had several built into this, where the .com was one bubble. All right, gold's probably had a couple. We'll probably see more bubbles in some speculative parts with gold. The real estate bubble, right, was maybe one, although maybe we're in another one. I don't know. we gotta check our rules at the end here to see if we're in another speculative bubble. Right?
We do, exactly. Doesn't meet the criteria.
Yeah. Here's a couple of things with then, particularly Bitcoin. But right now there are 4,000 cryptos. Did you know that? Over 4,000.
See, that's them. Yeah. We've been,
that makes no sense.
Yeah, exactly. I mean, and we've been keeping closer tab the last year or so on data and watching and cryptos and stuff like that. I didn't realize there were that many. I seriously didn't. That's crazy.
Well, I think I sent you a link not that long ago. You can go in and create your own cryptocurrency because they all sort of run on the same platforms, and they use the same coding, and so you can go in there and just create your own. And and we'll talk about this Dogecoin owner, creator, and some of the things that he says about it. But that was created as a joke, sort of as almost like an anti-cryptocurrency, really. And now it's huge. Yeah. I mean, it has a cap of 2 billion, I want to say, right now, and it was created as a joke. So,
it's so crazy.
Some issues that have to be dealt with on that. But let's talk about Bitcoin because that's the oldest. Sure. Started in 2009. Satoshi Nakamura, maybe that's his name. Is that his name? Satoshi Naka something? Nobody knows if he's an actual person. That's the name, but nobody really knows who it is. Right. 2009. So if you go back to 2013, Bitcoin is starting at about $123 per coin, and within 2 months of that, spiked 834% to $1,154 a coin. Wow. And that's all within 2 months, September to November. Then you have a drop of 81% from that peak over the next year and a couple months.
A little over, exactly.
Then you have, and it goes from $1,154 to $211, just to keep these numbers in line. Then you have another spike, about 2 years between that 211 trough to the next peak, 1,140.
Right.
What's happening and that's 2017, January.
17, yeah.
What's going on there?
It's
the
funny
election
too.
in 2016, right?
Yeah.
I don't know what's driving
that. Exactly. What's interesting here too is we've been more involved and tracked more recently, right? I'll be the first to admit, like, I never really got as deep into cryptos back in 2013, but I do remember watching or experiencing clients kind of like this little wave, right,
as they come,
because we look at, obviously we're really involved in real estate, tax liens, self-directed accounts, things like that, people investing in notes. I mean, a lot of really alternative pieces, right? And then manage a lot of stuff in the traditional markets, right? Stock, bond, preferred stock, all those kinds of investment trusts, all those things that are a little bit more common, right?
Right.
And so I didn't really think about this, but it's funny as you say that, because I do remember little blips kind of coming up, back in 13, in 17, right, where clients be like, "What is this crypto thing?" Right? And I would do a little bit of research on it, but it was like it would kind of die out, right?
Yeah.
So it's interesting that now, and I don't. Yeah. Anyways, it's just a really interesting. Keep going with this thought as far as following these kind of like ebbs and flows, right, which are extremely crazy sharp, right?
Yeah.
I mean, that's just bonkers. Trying to time those ebbs and flows is insane.
But just think of this. So that peak that we just talked about was January 4th, 2017, peaked at $1,140. In 8 days, it dropped another 31% on January 12th, 2017.
That's crazy, yeah.
Right? Now, this year, 2017...
you literally have to be on the right day.
Oh, that's such a massive drop in that long, short of a period of time.
Yeah.
But see, then you see this 2017 is when I started to hear it more. Before that, it was very in passing, didn't really pay much attention to it.
Yeah.
Because...
Yeah, exactly.
January 12th hits more of that bottom. It's not really a bottom, but it's kind of a bottom. $784. per coin by December of that year. So just about a year, 11 months. It goes up to $17,436. So 2,121%
crazy.
In less than a year. And we could speculate all we want about what's driving that. But that's back to when it was kind of tough to buy. Like, you'd have to go set up an account, get a wallet at some of these weird spots. Like, it was kind of hard to buy if you wanted to buy. Now you can go on Robinhood and buy it.
A lot more exclusivity back in 17 for sure. Yeah.
We'll talk about some of these spikes too in just a second, because I think there's some important points to this. But anyway, drops again, another 81% about a year later. Then there's about 6 months later, another big spike, 284% increase to $12,000 a coin. Well, $12,335.
Yeah.
What were you saying?
Well, let me jump in there. That's just so crazy, because again, I'm not going to try and say or speculate, because it's impossible to say when people jump on. But again, this is kind of this idea where, okay, if that value is being pushed by something, whatever it is, and you're like, oh, I hear about this. I think this is great. And you don't move on that till, say, because you're right, basically 11 months, right? Let's say I moved on that middle of the year, whatever. Maybe I capture some of that. But it's like, I mean...
But as soon as it hits the top, it's going down again fast.
Losing 81%. Yeah, exactly. Like, when are you getting... And that's, I'm seeing it all over the place now of people coins are... They're ready for another rally. They're ready for another rally. And it just keeps dropping, right? Yeah. It's like... Yeah, and we're going to get to this when it comes to the identifying factors, right? But... Man, just think about that. Like who's got the guts to be in that ride where you're up to 2,000% or down 82%?
Because there's people, you hear people talk about it, and they're like, well, I mean, if I would have been in 2013, I'd be up X amount of dollars now. It's like, yeah, okay. Do you think you would have made it through all of those peaks and valleys through that time? I mean, we're talking right now so far.
Exactly.
1, 2, 3, 4 really big peaks in about 6 years.
Yeah, and
4 huge peaks in 6 years.
All of these peaks to troughs make
massive.
2008 look like a small correction.
Yeah. Yep. As far as those percentage and those swings, it's nothing. It's not even close.
Exactly. It's crazy. So crazy. Yeah.
So now all of us are very familiar then what's happened basically in the last year and some, because then it bottomed out again a year ago, March, right in the middle of the pandemic started last March, 2020, went all the way down to $5,465 a coin. And then from there until just barely last April, 4 months ago, spiked up to $63,000 a coin. $1,000. 1,000%.
Exactly.
1,000% increase in that year. And then, since then, and it was really May that did it. I have it here from yesterday going down to 30,662, which is a 51% drop. It's lower than that now. It's in the $29,000 range today.
Yeah, that's probably more like down 60-ish%. Yeah,
close
from that
to
peak to valley. Yeah.
And, there's a lot of pressure points that are coming into that because what happens on all of these inflation upswings, everybody's excited, everybody's getting in, and they're also leveraging, which is why you can see these wild swings. Yeah. They're leveraging their positions to get higher, and then you see these big decompression of that. It's deleveraging, and the problem is where you're at on that mountain when it starts and when it ends. Right. Where are you at in that process? And it's a wild ride. I don't know who can really stomach any of those things if they've got any significant amount of money in it.
Seriously, and that's I can't remember if we did an episode on this or not, but it's like some of these meme stocks, right? It's been so interesting watching those because, and it's the same concept, right? It's like as you hear about these later in the game, if you're not on that early spike, especially too as we're talking about crypto, because one of the things we look at as we understand market swings is we'll look at, how is that arc, how is that spike, how is that jump, right? Is it a sharper angle? Is it a more gradual growth? Is it more cyclical, right? And that's the whole point here is, man, a matter of days makes difference in, hundreds of percent change, right? And so, think about people just barely getting into this. It's like, again, with the meme stocks, cryptos, there's a lot of similarity where it's like you get, and we're gonna talk about in just a minute some of these warning signs, but it's like you jump in thinking that you're gonna get in on this, but unfortunately, you're part of the problem, not part of the solution. And what I mean by that is you're jumping in at a much higher value than people that bought it even a week ago, right? And you kind of made them all the money, and you now own something that's way expensive, right?
Yeah, and the article that we've kind of passed back and forth and talking about the creator of Dogecoin, which has kind of been famous with Elon Musk this year. It's created as a joke, and he came out and talked a little bit about cryptocurrencies. He's not involved anymore, by the way. He doesn't have any money invested in it. He's away from it. He's not involved at all.
Jackson Palmer is his name. Yeah,
not involved at all. And he really came back and said, look, cryptocurrency is built for speculative bubbles, and it is built for really people with money to make more money, and it kind of leaves those on the other end of the financial spectrum kind of holding the bag. And he kind of points out a couple of important points. Now, these are not our 3 points that we'll talk about in a sec, but they fit into this. One problem is transparency. One problem is regulation. And, I'm going to forget the third one. There was a third one. He talked about it. Oh, built-in. What's the word? With scarcity. Built-in scarcity. So there's these issues. It's almost as if cryptocurrency was created by somebody thinking, how can I make money in something, and I'm just going to create it basically, because cryptocurrency is a code. Right. It's based on cryptography and this idea of the blockchain. It's not in the tangible world like cars and shoes and banking services and right. So it almost feels like, and this is sort of his point, it wasn't created necessarily for what we think it's created for, which is sort of replacing our monetary system. It was created as a way. It kind of brings out the worst parts of capitalism in it, which is that it can be manipulated very easily for those that are on the inside.
I mean, in fact, think about that. Just a few months ago when we were talking about, as we were, it was like on a Friday or Thursday or Friday or something. I was at my daughter's softball game, right? And we saw like a 30% drop one night.
Yep.
In like an
one
hour.
Night. Yep.
And Robinhood stopped trading, right? And it was because Elon Musk was basically just like, there's too much there's too much of an environmental impact on this. I don't really like this thing anymore, right? Like that's exactly to your point, right? Like that's a really wealthy person saying one thing, and it wipes out 30% of that value. Right?
Yeah, it's bonkers.
That's insanely bonkers.
And this idea of scarcity, and here's the thing with it is that scarcity can be used, or security and scarcity kind of go together with this a little bit. Those two topics can be used to drive these market upswings, where they can basically sell the idea.
Yeah,
they can manipulate the foundations of it. Because when you think about the idea of scarcity, how is scarcity created? Well, it's market driven. It's not a single person, or it's not a system. It's market driven. Scarcity in real estate, scarcity in gold, scarcity in value companies. Right, those things are all driven by market conditions. Well, what drives the scarcity of cryptocurrencies? Bitcoin only has so many bitcoins.
Yeah, just the fact that they make it.
That's how they made it.
It is created to be financed. Yeah, exactly. Yeah. Like we did.
So it is interesting.
It on purpose that way.
It is interesting as he brings that up. It's a thought that I haven't really had. Like, it's a man-made scarcity, specifically because that's one of the things that really drives speculation is scarcity. The belief that whatever you're investing in, is going to go up in value, and in this case, it's going to go up in value because, hey, it's a rare thing, and you don't want to miss out on that train. Anyway, so this kind of brings us to this wrap-up point that we've sort of talked about.
Right.
What these main 4 things that we're focusing on.
Yeah, and before, just real last thought before we get to that is, the interesting thing here, and I'll relate this back to our first episode of this Peak to Trough with .com, is there's something so interesting about the crypto speculation and all this bubble we're talking about.
Yeah.
But what's, we're not saying that like all of a sudden cryptos are going to go away overnight and it's just completely stupid. It's like, no, obviously, we see the risk in it. That's why we're having this podcast. That's why we're talking about this. There's no doubt in my mind that this technology and the usefulness is starting to evolve, and there's going to be, some usage from this over time. Right?
For sure.
The point is, though, the point of all of this and all of these peak to troughs is we really are just trying to help people understand that, like, look, don't, like, if you think you can time this and you think you've got your hand wrapped around this, like, or your mind wrapped around it, you don't. You really, really do not. You know what I mean? Yeah. And so to risk so much of your retirement, your investment, your savings, whatever it is, on this idea, guess what? We've watched people try and do that before, and it's come back to bite a lot of people in the ass.
Oh, so many.
Right? How many people lost their shirt with .com? How many people lost their anyways. So,
well, that's a good point, because this is not about the investment itself. It is about the trying to avoid getting caught up in the speculation. Trying to avoid
exactly.
What's the mindset going into this? If you want to be a part of it,
yeah.
Okay, here are some tools you can use to get involved with it. Because again, crypto's going to be around. Yep. It's not going away. Just like .com didn't go away.
Right.
It just evolved and changed.
Yeah.
Real estate didn't go away. Gold's not going away. These things are there.
Right.
How do we engage?
Yeah. And they're being used, being used in a speculative manner to try and generate excessive wealth in a fast way that, to be frank, it does not work for the masses. Ever. Never has and never will.
Yeah.
Get rich quick schemes. Honestly.
Here's our 3 things, Ty. You ready?
Okay.
Yeah, that's actually a good point. They do come down to this idea of get rich quick, and that fits into the first one.
Yes.
Right?
Yes.
Which is, and we talked about it on the crypto FOMO, check your FOMO at the door. And FOMO is?
The door.
What is FOMO, Ty?
Fear of missing out.
Yes.
FOMO.
It is this idea.
FOMO.
That is the get rich quick scheme. That is, I am afraid that I'm going to miss this train. It's going up.
Yep.
And I don't want to lose out again. That's the first thing. Right. And we've talked about this in all the previous ones, and every single one of those had this FOMO event. We talked about the .com bubble, where people were actually getting out of the S&P because an 18% return in 1 year wasn't good enough.
Was not good enough. Exactly.
Sold their S&P companies to get in these NASDAQ .com companies because they were like, it's going up 80% a year. I can't miss that.
I can't miss out on that. Yep, exactly. And you know what's funny is and we talked about this idea of like when you start seeing banner ads or pop-ups, right, or billboards along the freeway. But it's also this idea. It's like when not that your friends or family are dumb. It's not what I'm saying. But when all of a sudden Johnny next door or Uncle Bill becomes a real estate expert or becomes a .com expert or becomes a crypto expert, and this is why you should. In fact, one of my friends' parent, I had this conversation with one of my friends, and the parent, one of the parents had said, yeah, you probably ought to buy some of these cryptos because, man, I know somebody that if they would have put, $1,000 in at this time last year, they'd be a millionaire today. It's like, okay, that's your investment advice. If that's the investment advice you're following, it's like, that's FOMO. That's greed. That's, I can't miss out on this. If everybody else is doing it, I got to do it. It's like, anyway.
That should really be your first signal is that if you feel that fear of missing out, that you feel that FOMO, that's going to be your first sign. Okay, we're definitely in a speculation bubble right now. Yeah. So I got to kind of dial this back a little bit and go to these next 2 so that I can make some informed decisions here. Because again, like, hey, maybe there is speculation and I'm feeling this. But then you go to step 2 and 3, and that helps ground you a little bit, and you can make some better decisions for it. So check your FOMO at the door, Ty. Just check it. Like a coat.
Exactly.
You can pick it up later.
Before you wreck yourself. That's right.
Yes, good one. Second one is try to figure out what is the intrinsic value here. Now, maybe we're playing, play on words with intrinsic. What's the extrinsic or intrinsic value? Whatever the case, what is the value that this investment is being based on? And does it correlate to that? Right? So give us some of the basic ones.
Well,
that we all kind of know.
What I like about the PE ratio, appraisals, what's actually the merit of the investment? What's the meat? Intrinsic value is like what's the word in, what's inside of the value, right? What's in there? What's behind this thing? And here's the thing, like PE ratio, some of these things, they do get a little bit more technical, right? I mean, that's part of the technical data that I look at every day, right? I look at technical data all the time to try and understand. Like right now, the markets are kind of being crazy because everybody's afraid of inflation, right?
Yeah.
Well, let's really understand what's going on inside, right? And that's what I'm saying. You don't have to be crazy hyper trained or like have a bachelor's or a master's in finance or have done this for 20 years to know these things. It's like again, we keep coming back to Nike, right? Like, does Nike have something in there at the end of the day that, they may have some waves and go up and down, but is there going to be long-term value because of what's inside of Nike?
Yeah, right.
That's what it comes down to. So you don't have to be a genius to understand the intrinsic value of something.
But that's the thing. So you can really kind of help yourself understanding some of this stuff. FOMO part, okay, I feel that, okay, what's the next step? Let me look at the intrinsic value of this thing, right? And this is where it can be difficult, like .com. What was the intrinsic value of .com? Nothing. So many of those companies.
Pets.com.
Pets.com, Webvan. They didn't have value because they had no revenue. That's the only thing you are going to look at with a company for value is what is its revenue.
I know.
And you can tell with some companies when they're price to earnings, meaning what you're paying for the stock versus what it's earning. The higher that number is, it's more speculative because they're not making very much money. But maybe they got a good product, maybe they got good technology, whatever the case, you can still look at those intrinsic values to come back, and .com had nothing.
Exactly. Well, and
not all of them, but
here's the
most of them had nothing.
Most of them. Well, and I mean, think about that. It's like the price, because I mean, think about this. So like somebody's willing to pay a little bit more for Nike on any given day than another day, right? Stock prices go up and down. Right. People are willing to pay. So that concept is embedded even in regular, more traditional investing in stocks. In crypto, the entirety of its value, I guess I shouldn't say the entirety. Like if Nike, if what people are willing to pay, like maybe pay a little bit of a premium, which really is what price to earnings is. If Nike you're willing to pay 10 to 15% of that value as a premium. Right, you and I read that article late last week where we talked about the market premium being a little high, about 15 to 20%. Right. Yeah. Okay, that's fine. That's in Nike. On cryptos, it's like the opposite. It's like 90% speculation. Maybe there is, some underlying intrinsic value. Maybe, right? Maybe it can. Maybe the blockchain technology will end up being, a useful tool down the road, or maybe it will be a currency of some sort. But it's the opposite, right? The intrinsic value is on the opposite end of the spectrum. It's 95% speculation, maybe some true value of 5%. Right.
And the difficult with it is trying to figure out what is that intrinsic value, because that intrinsic value is going to be based on something we're using, and we don't completely know yet. It's still in theory. So think of it in this way too. And you talk about maybe an appraisal for a property. You can also look at wages in that area. What someone's willing to pay for a property is going to be completely based upon what people are making. Right? Absolutely.
Is it a good, location, right? That's what real estate's all about. You're maybe paying a premium. Like here in Utah County, you're going to pay a little bit more of a premium to live in Lehigh, right here, where our office is. Or like if you move down to, say, Santaquin, the south end of the county, you're not going to pay as much because it's further away from things. But again, that makes sense, right? There's an intrinsic value. Now, whether you want to pay it or not, that doesn't matter. Maybe you want a little bit quieter neighborhood and less traffic, and so you go to Santaquin. But my point is, there isn't that's like, again, it doesn't take a genius to understand that, okay, I'll pay a little bit more. There's a little bit more value there because it's in Lehigh.
Yep.
Right.
Right.
I do want to take this a little bit further and not to be a traditionalist here or sound like an old fuddy-duddy or like, I mean,
that's your role.
I'm not
your role is the fuddy-duddy.
I like Warren Buffett. I really do.
Sure.
Because, and there's good and bad things, but what I love about him is how simple he is with investing, right? He's like, I love where he talks about the napkin test. If it doesn't pass the napkin test, he won't invest in it. It's like, because he doesn't follow speculation like that. If there's no intrinsic value, why in the devil am I going to put any of my money into it?
Yeah.
Yeah, I may miss out. So what? Like, unless I time that perfectly, I'm not really missing out on anything. So, anyways, intrinsic value.
Well, that's
FOMO,
a good example.
Intrinsic value.
Yes. And that brings us to this third one, which is maybe a little bit more complex, but it just takes a little extra time to look at. But it's important because you can make some really clear calculations just by looking at a graph. If you look at the past investment values of whatever it is that you're looking at. And what you're looking for are big spikes, big troughs. You're looking for how fast is it increasing in value. Because the thing that we know about general investing principles is that it's difficult to sustain growth above 10, 12, 15%. You can't do that for a very long period of time. So if you're seeing increases of 30, 40, 50%, and in the case of cryptocurrencies, 400, 1,000%, what it tells you is nobody really knows what its value is. Nobody knows. If it's increasing and dropping that fast, nobody knows what the value is. Everybody is speculating. So therefore, just know what you're getting in if you do it. Stay away from it, or just be calculating and doing it.
Well, and we also talked about this before too, a few episodes ago. But the funniest thing about this, right, and this kind of sounds boring and a little bit antiquated, and it's not. There's not a lot of the sizzle.
Fuddy-duddy.
I mean,
sounds like a fuddy-duddy.
Yeah, fuddy-duddy.
Here comes the fuddy-duddy advice.
That you just made such a key point. Because when people are like, oh, I want that I want to have that 20, 30, 40, 50% return, like. You're really like looking for a unicorn, right?
Yeah.
And that's not the way it works. If the people, in fact, there's a really good, I can't remember which of his books it is. Tony Robbins has one of his, it's escaping me now. Anyways, he was talking about building kind of this perfect long-term portfolio, right? And the idea comes back to, look, the expectation should never be... Now, don't get me wrong. If you can find a good investment and you make 20, 30% 1 year, awesome. That's great. 40%, great.
Which can happen,
You're an anomaly. You really are.
Yeah, short-term
but
stuff
the idea,
can happen.
if you can kind of build that continuous 8 to 15% growth, right? Now, that's not guaranteed, and we're not making earnings claim or projections here. What we're talking about is with different tools, if you do that, and you just continue to build like that through your retirement years, like building up to your retirement years, holy crap, that is all you need to do, right? That's literally all you need to do. That's it, right? Anything else that's kind of this catching lightning in a bottle, and that's the crappy thing is, unfortunately, that's what sells. People are sold on 20, 30, 40, 50, buy this crypto and all your problems will be solved. It's like, no, I'm sorry. It's not it's like we talked about with dieting, right?
Yeah.
Financial planning is a lot like dieting.
Yeah.
To talk about some new crazy scientific diet that's going to make you lose 50 pounds, it's awesome. People are going to eat that up, pardon the pun. But to say, no, look, eat well, exercise, and make sure you drink a lot of water. Like, that doesn't sell. Do you know what I mean? But that's, unfortunately, that's the way life is. Same thing applies right here, right?
Yeah, and you think about just kind of correlating that to any investment you want to look at. you can easily go into it and make some sense of this thing and say, okay, well, all right, am I afraid that I'm going to be missing out? Okay, that's step one. Step two, what is the value that this is based off of? Right? Look at real estate in 2006. Were real wages keeping track with home prices? Answer was no. Well, why not? You can make some of those assessments and go, for some reason, people are paying more. Now, granted, again, we're 2020, looking back at this. But this is important as we move forward. You can make some of those basic calculations.
Well, even to that point, like we can look at it too, and I would say that we have just as much of an income disparity with the value of homes right now as we did then. Mm-hmm. But here's the thing. There truly is a scarcity of homes right now.
Yep.
Right? There is right now is truly a demand and supply, which, look, if you're going to have a problem in a market, that's actually not a bad problem to have, because it warrants true market value, right? People, now don't get me wrong, the markets are nuts right now, right? Like I would never pay what some people are paying over asking price on certain properties, right? But we're already starting to see it slow down, and that coupled with interest rates being insanely low. But again, you can look at that and say, okay, like, I mean, in 2006 and 2007, you started to see, there would be 25 houses, and every person, how many investment properties do you have? Oh, I've got 3 or 4. It's like, something's out of whack when every person has 3 or 4 investment properties. Oh. And you
growth
and,
is going
what did you need to do to get your, what did you need to do to get your loan? Nothing. Like I really didn't have to work for it. I just I just kind of told somebody that I made $190,000 a year, and I don't really make that. It's like, yeah, exactly. When these things come up, when these speculative cure-alls come up, there are a lot of those similarities there, where it's kind of getting rich quick. There's not much value, not intrinsic value there. Something's out of whack. Something's always out of whack.
And again, that's kind of where you can use this very simple system that me and Ty have created here. Check
how to stay rich in 3 easy steps. Yeah.
Really dive into intrinsic value, and you can, call somebody who you trust if you're not sure. Talk to somebody about those intrinsic values. Hey, I see house prices are going up really high. Talk to me about that. What do you see? What's going on? And then the other thing is just get a sense of the trajectory of this thing. And you can go look at those graphs of Bitcoin, and you go, that is nuts. That's crazy.
Yeah.
The spikes and the troughs on that whole thing make zero sense as to why it would go up that high and down that low in such a short period of time.
Yeah.
And that should leave you then with the question of, okay, maybe I'll do 3 or 4% of my portfolio that way. I can risk that.
Yeah.
Maybe that's the decision.
Right, exactly.
And the other decision could be, I'm not doing anything. Right. I can't predict any of that. I'm not doing anything. That's sort of the point in all of this, is where to make the best sort of calculated decision for it.
Right. Exactly. But when you're starting to say, you know what, I really need to make sure I'm okay in retirement, I'm going to take 20, 30, 40% of my money and do this?
It's rough. That's look.
What would Ryan do?
You're in the FOMO stage. You're in the FOMO stage.
Yeah, you're in FOMO stage.
You missed step 1.
You missed step 1.
You brought your FOMO in with you. You're supposed to leave it in the coat rack.
Well, and then the funniest thing is, I think when you skip step 1, it's easy to convince yourself in step 2 and step 3. Very easy to convince yourself.
Because step 1 gives you
because our entire economy is going to go to the crapper, and so we need a new form of currency. It's like,
that's right. You don't check your phone with the door.
Our entire economy goes. Yeah,
you're not going to look at the intrinsic value.
Yeah. Yep. I like it.
Have we beaten the dead horse?
Yeah, but have we protected people enough? Have we come in on our white stallions with our swords raised high in the air and saved everybody?
Yeah, we're gonna get the hate mail like, I made so much money on Bitcoin. You don't know what you're talking about.
I sold my Bitcoin because of your podcast episode, and then it went up 195%.
True.
F you.
True.
Okay.
That is a truth.
I'm sorry.
For where it's at now.
It is very true.
Whatever. But you shouldn't have been in the first place.
Good times. Yeah.
Ty, anything else you want to say about this? we're finishing up this series. You feel good about it?
Yeah. Again, I think we've beat the horse very dead. It's gone. But no, I think it's good. It's understanding that this is the marathon. It's not a sprint, right?
Yes.
And that's the whole point. That's the whole point of why we're here. I'll be like they always say, like the comedians always say, I'll be here all night, right? That's what we're doing here, is just to kind of say, listen, we've been here, we've been through it. I know we're young guys, but we both kind of, that's kind of the cool thing. We both came in to our careers with .com, real estate. We saw this stuff, right? And that's what I'm saying. If it looks like, smells like, acts like, chances are it probably is.
A duck. If it quacks like a duck and walks like a duck, it's probably a duck.
It's probably a duck. That's
right.
Follow
the 3 steps, and you're like, oh, speculative bubble.
That's right.
Ty and Rye told me. I know now.
FOMO. I am fearing that I'm going to miss out on something. Yep. Well, there's really no value to this thing. Oh, wait. Its historicals are pretty crazy. Okay, I won't put $1 million of my retirement dollars into this. Okay, fine.
Yeah. Well, and if you need help somebody to check your FOMO, that's fine. It's like a sponsor.
That's right. Yeah, we're good.
Find a FOMO sponsor.
A FOMO sponsor. That's right. Ryan will be your FOMO sponsor. So.
Yeah. Okay,
good times, my friend. Good times.
Hey, another good podcast. Thanks for your time. Everybody check us out. tyandrye.com. Subscribe and follow us.
I'm Ty. He's Rye.
Thanks, Ty. We'll talk with you next week. Hey, thanks for listening to the Ty and Rye, the Finance Guys podcast today. If you liked what you heard, go ahead and hit subscribe. That way you won't miss any future episodes. Also, follow us on Instagram, Twitter, Facebook, Ty and Rye Podcast. Also, check us out at myprosperteam.com. Thanks. We will see you next week.